Okay. So anyway, finishing up our lecture on chapter 17, dealing with pensions. Um, we pick it up at our PowerPoint slide number 13. I think that's where we finished up. So, and that's part B on page 973, by the way. And so they talk about three ways to measure the pension obligation that have some meaning in pension accounting. The first of those is accumulated benefit obligation. That's the actuary's estimate of the total retirement benefits at their discounted present value earned so far by employees applying the pension formula using existing compensation levels. So whatever they earn right now, yearly, times whatever the formula is. For instance, I mentioned, and they have in the book, the formula of 0.015 or 1.5% times however many years of work service to date times the salary earned right now. Next, there's vested benefit obligation. That's the portion of the accumulated benefit obligation that plan participants are entitled to receive regardless of their continued employment. Normally, there's some time frame in which the employee must work before they become vested in the pension plan. Quite common is 5 years. Next, we have something called the projected benefit obligation. This is the actuary's estimate of the total retirement benefits at their discounted present value earned so far by employees applying a pension formula using estimated future compensation levels. So, and when the book talks about the benefit obligation, they're referring to the projected benefit obligation. So the ABO or the BO, the benefit obligation that they talk about is the projected benefit obligation. So you can see here that the PBO engulfs the other two. So ABO ignores possible pay increases in the future, so it's really, of minimal use. Like I said, vested benefits, normally they have to be with the company for a certain amount of time before they're vested in the plan. Under the pension laws that are in existence today, benefits must vest within 5 years or 20% within 3 years, with another 20% vesting each subsequent year until fully vested after 7 years. But anyway, normally it's the 5-year period. So the PBGC is the law that's in place, and they created this guarantee corporation to ride herd over companies that have these pension plans. And so because the PBO uses projected future compensation levels, it's certainly less reliable because today nobody, not even an actuarial, can determine precisely how much someone's going to make in the future. Certainly not 20 years down the road. But as it says here, it's more representationally faithful. So this is the measurement of pension liability used to report amounts in the balance sheet and income statement. So here we have an example. This, and again, they break it down to its simplicity of just dealing with recording pension benefits for one employee, but in actuality, what would happen is there would be a pool of employees that this company would have to determine the PBO on. So this employee was hired in 2007. The company has a defined benefit pension plan that specifies annual retirement benefits equal to 1.5% times service years times final year's salary. She's expected to retire in 2046 after 40 years of service. Her retirement period is expected to be 20 years. At the end of 2016, 10 years after being hired, her salary is $100,000. The interest rate is 6%. The company's actuary projects her salary to be $400,000 at retirement. What is the company's projected benefit obligation with respect to this employee? And so what you learn is that this is a three-step process. So first, you use the pension formula, including a projection, I bit my tongue, including a projection of future salary levels to determine the retirement benefits earned to date. Number two, you find the present value of the retirement benefits as of the retirement date. And then you find the present value of retirement benefits as of the current date. So let's run through that. So she's put in her 10 years, started in 2007, it's now 2016. We expect her to work 30 more years, and at the end of 2046, she's going to be retired, and that retirement is projected to last for 20 years. So step one, she estimates, or the actuary estimates, that the employee has earned as of 2016 retirement benefits of 1.5% times 10 years times her projected salary at the end of her retirement or her employment of $400,000, which equals $60,000 per year. In step two, you're going to take that $60,000 per year and figure out the present value of it, because that's the amount that's going to have to be paid for 20 years starting in 2046. And so you multiply, and again, n equals 20. I is the 6% rate that was stated. And so the annuity, the present value of the annuity at the retirement date is 60,000 times 11.46992 equals 688,195. And so you're going to take that 688,195 and in step 3 you're going to calculate the present value back to 2016. So you're going to have to use n equals 30 here, and of course I still equals 6, and so the PBO is the sum, which is 119,822. Now they move it forward 1 year and they do the same thing. She's 1 year closer to retirement, 1 more year of benefits has accrued for her, so she's now at 11 years. So step 1 is now 66,000 per year. Notice that the estimated salary has not changed. If it had, they'd use that new salary. We'll show you that, I believe, later on in the lecture. In step 2, there you're still using n equals 20, I equals 6%, but here you're using 66,000 because 1 more year of benefits has accrued for her. She's 1 year closer to retirement. So that's 757,015. You take that and notice in step 3, we're now in 2017. That's now 29 years till retirement. And so you use n equals 29, I equals 6%. And so here the PBO is 139,715. So it increased as it should, because she's 1 more year closer to retirement. And 1 more service year is included in the pension formula calculation. So notice you've got a service cost and you've got an interest cost. And so the service cost is there for every year that service adds to the obligation to pay benefits. This represents the increase in the projected benefit obligation attributable to the employee service performed during the year. Interest cost accrues on the PBO balance as time passes. It's calculated as the assumed discount rate multiplied by the PBO at the beginning of the year. Now we'll see some examples here of when prior service costs change. When a pension plan's amended, credits often given to employees retroactively for services rendered in prior years. The cost of doing so is called prior service cost, and so the example they have is, for instance, the formula changes from 0.015 to, I think their example is 0.017, so they're increasing it. So here they revise a pension from 1.5% to 1.7%, so that the formula now is 1.7% times service years times final year's salary. And of course, it's going to have some, in those service years, there's going to be some prior years where you have to accrue additional PBO as what they call prior service cost. And so this cost increases the PBO as a result of making the amendment retroactive. If it wasn't retroactive, it wouldn't change the PBO presently. You would just go forward and calculate using the new formula. But here, notice that this is an example where it's retroactive. Thus, previous benefits are recalculated using the more generous formula in addition to applying it to future years' service. So they have to add an additional 15,976 to the PBO because of prior service cost. So it goes in our example, going back to 2016, or they change it at the beginning, I believe, of 2017. Let's see if that's the example here. Yeah, in the example in the book, the plan's amended so that the new formula is 1.7% instead of 1.5%. So at the beginning of 2017, which is the same as end of 2016, PBO for this employee is 119,822, and so they're calculating the additional amount, the prior service cost, that they have to add to it. Now, at the end of 2017, service costs is going to be using the new amount, 1.7%. So the second part of service cost is using this new formula. So this catches everything up. And notice you have an interest cost using the new number as well. And so PBO at the end of 2017 is 158,341, whereas before it was 139,715. So, as it points out, this amendment is going to affect not only the year in which it occurs, but also subsequent years, because the revised pension formula determines each year's service cost. Makes sense, huh? So, for 2018, PBO at the beginning of 2018 is 158,341. You add more service costs you're another year closer to retirement here, so it's 15,258, and then your interest cost, you simply multiply the 158,341 times 6%, Why are you doing that? Well, you've accrued one more year of interest on 158.341, the beginning balance at the beginning of 2018. So during the year of 2018, you're accruing interest at 6% on that 158.341. And so you end up with a PBO at the end of 2018 of 183.099. You can see why companies don't, except the very large ones and governmental units, why they don't like dealing with this, because it's such a pain. It's very, very expensive to administer, and there's a lot of uncertainty involved. Certainly the defined contribution plans are much simpler, as you saw. All right, so we are at page 978. Now here they talk about gains or losses. These are decreases or increases in estimates of the PBO because of the periodic reevaluation of the certainties that exist with these defined benefit plans. And so when one or more of these estimates requires revisions, the estimate of the PBO will also require revision. And so the resulting decrease or increase in the PBO is referred to as a gain or loss respectively. And so here, what we have going on is a change in the estimate of this employee's ending salary. They now estimate that she's going to make $420,000 in that last year before retirement rather than $400,000. And so they calculate that. And this is, when is this? At the end of 2018. So she's accrued two more years. We started this after she had 10 years of service, 2016. Now it's the end of 2018. She has 12 years of service. At the end of that 12th year of service, they re-estimate what her ending salary is going to be. It's now $420 instead of $400. And so they revise the estimate with that new number. And so their PBO increases. And so that increase due to the estimation is considered a loss on the PBO. And notice that a loss creates an increase in the obligation on this employee. Now, what if the estimate was that she would not make as much? Let's say it was $380,000 at the end of her employment. Well, that would create a reduction in the estimate of the amount she would receive using the formula in step 1. That would be a gain on PBO. That would actually be a reduction And so instead of adding a loss on PBO, you would subtract a gain on PBO from the total PBO at the end of 2018. So that's what that says there. If a revised estimate causes the PBO to be lower than previously expected, a gain would be indicated. Other possible estimate changes would affect PBO. Life expectancies. Expectation that retirement will occur earlier than previous thought, and of course the change in the assumed discount rate. It's now at 6, but that maybe there's inflation, so they have to upgrade that to a higher discount rate. The last thing that causes a change in PBO balance is payment of retirement benefits. Once you start making payments to retirees, that's less of an obligation that the company has. And so the obligation is reduced as benefits actually are paid to retired employees. And so going back over this, components of change in the PBO. You're going to add service cost to it each period. You're going to add interest cost, except for the first period of the plan when no obligation exists to accrue interest. Prior service cost if the plan is amended or initiated that period. Loss or gain on the PBO. Again, loss adds to the PBO, gain subtracts from the PBO when there's revisions made due to changes in estimates. And then last but not least, retirement benefits paid reduce the PBO unless no employees have yet retired. So here's an example of that for this company. And again, it would be for all employees who were eligible for some benefit, pension benefits in the future, not just one employee. It would be ridiculous to think of a defined pension plan or a defined benefit plan with just one employee in it. So here, the beginning of 2018, 400 million, service costs of 41 million, interest costs that you're simply going to take the current interest rate and multiply it times the beginning PBO. So that's the amount of interest that accrues on the beginning balance of the PBO. Loss or gain on the PBO, here 23. Not sure where that number comes from. We'll just roll with it as a given. Not seeing that anywhere. And then they've paid 38 million during that period as well. So the PBO at the end of 2018 is 450. Now it's also your beginning number for PBO in 2019. Thus, when you consider interest cost, the beginning number will be 450 million times 6%, assuming that hasn't changed. Okay, so amounts are assumed. The other side of all this is pension plan assets. The the assets that you're going to use to pay your pension benefit obligation. And so these pension plan assets are paid over to the plan trustee. The plan trustee can be an individual, but usually it's either a bank or a trust company. And so the company invests, the trustee invests the cash that's given to it by the company in the stock market usually, as well as the bond market and other income producing assets. And so the hope is that the corpus of the pension plan assets, which are the assets of the pension plan, produces enough income in the future to pay these pension benefits or pension obligations to the company, pension benefits to the employee. And so what the company is required to do, they're not required to put the PBO on as a liability and the plan assets as an asset in the balance sheet. What they have to do is net the two and show the net amount as either a net pension asset if you have more assets than you have obligations, so that would be a debit balance, or in many cases what you have is a net pension liability, which is a credit balance because there's not enough plan assets to cover pension benefit obligations. And that's pretty common to have. It's not a surprise to see more often than not a net pension liability, meaning not enough assets to cover pension obligations. So if you hear the term unfunded pension obligation, and you probably have on the news, usually we're concerned about the unfunded pension obligations of, for instance, the state of Oregon. They've got a huge unfunded pension obligation, like I don't know, $1 billion, $2 billion. When you're talking about $1 billion, what's one more billion, right? It's a lot. And so there's concern as to whether and how to cover that. Not sure I know the answer. All right, so here we're looking at the assets that the company sets aside with the trustee to pay its benefit obligation. Well, how do these assets change? Well, I kind of gave it away. They can certainly contribute money, and if they have a deficit, they can certainly contribute more to the pension fund than they're obligated to under, let's say whatever the pension expense is. And so here in this example, this company contributes $48 million to the pension fund at the end of 2018. Plan assets at the beginning of 2018 were valued at $300,000. The expected rate of return on investment of these assets was 9%, but actual return for that year is 10%. Retirement benefits of $38 million were paid at the end of 2018 to retired employees. Recall that their PBO at the end of 2018 is $450 million. And so they asked the question, what is the value of the company's pension plan assets at the end of 2018? Well, you start with the beginning value, $300 million. To that, you're going to add the actual return on plan assets of $30 million, the 10% times $300 million, plus the cash contributions, less the retiree benefits paid of $38 million. So plan assets at the end of the year is $218 million. And so, like I said, when companies report on the funded status of the pension plan, they report the net difference between the plan assets and the PBO. So 2017, you can see they've got an underfunded status of $100 million, and it's grown, even though they put more in, $48 million in, than they paid out. They still have a PBO of $450 million, but they only have plan assets at fair value of $340 million. So they have an underfunded status at the end of 2018 of $110 million. So they're losing some ground there. And so at the end of 2018, the net pension liability on the 2018 balance sheet would be $110 million. So anyway, changes to the, well, here they're talking about the pension expense that we have to record. Okay, so here's how we figure that out. Service cost, we've already talked about that. Interest cost, we already talked about that. Expected return on the plan assets. Not the actual return, but the expected return on the plan assets. That's the estimated long-term return from changes in the value of the plan assets due to dividends, interest, blah, blah, blah. So we saw that the expected return was supposed to be 300 million times 9%. The actual was 300 million times 10%. But here, in determining pension expense, we use the expected return. So we would use that, we would have expected a return of 27 million, which we'll see here in a minute. And then you have two other things that we'll have to talk about. Amortized portion of prior service cost and a net loss or gain on the PBO. So best way to do this is by our example. We already have some of the numbers here in 2018. We have service cost of 41 million. We have 24 million interest cost. The loss on PBO, remember, is 23 million. That's a given. And retiree benefits of 38 million. So these are numbers that were given. And then our assets We've got that at the end of 2018. So here we're assuming a prior service cost of $60 million was incurred at the beginning of the previous year, 2017, due to the plan amendment increasing the PBO. Also assume that at the beginning of 2018, Global had a net loss of $55 million. So previous losses exceeded previous gains. Also, for this exercise, the average remaining service life of employees is estimated at 15 years. All right. So, in determining pension expense, we're going to take our $41 million, our service cost, our interest cost of $24 million, our expected return on plan assets of $27 million. It's the 30 actual less the $3 million gain, which is the difference between actual and expected. We'll still have to do something with that $3 million gain, which we'll show you here in a minute. And then, like I said, amortization of prior service costs, which we'll calculate here in a minute and talk about, and amortization of net loss, which we'll talk about here in a minute. So here, pension expense, which would be a debit, obviously, $43 million. So we've kind of gone through all these. You've covered that. We've covered that. Covered that. Covered that. All right. So now we're at this amortization of prior service cost. So recall that $60 million increase in their PBO was due to recalculating benefits earned in prior years as a result of the plan amendment, this going from 1.5% to 1.7%. And so the prior service cost adds to the cost of having a pension plan. So the question is, when should this cost be recognized as a pension expense? Well, FASB has said that this additional expense should be amortized gradually, not immediately. And so it's recognized as a pension expense over the time that the employees who benefited from the retroactive amendment will work for the company. And so here, the average remaining service life of the active employee group is 15 years. And so to recognize the 60 million prior service costs, you simply take the 60 million and divide it by the average remaining service life of 15 years. So every year they're going to amortize $4 million. And so that's an added pension expense of $4 million every year for the next 15 years. Says, be sure to note that even though we're amortizing it, the prior service cost is not an asset, but instead a part of AOCI, accumulated other comprehensive income, a shareholder's equity account. This is the result of FASB's distinction to treat the cost as an expense as it is incurred. The board instead prefers to consider it to be other comprehensive income, like the handful of losses and gains also categorized the same way and not reported among the gains and losses in the traditional income statement. If you recall, the fair value of investments was treated that way when you elected the fair value option on investments. And so every year, this prior service cost will go down by $4 million. All right, so next we want to talk about this amortization of net loss or net gain. So we just talked about this, that gains and losses can occur when expectations are revised concerning either the PBO or the return on plan assets. Like prior service costs, we don't include these gains or losses as part of pension expense in the income statement, but instead report them as OCI in the statement of comprehensive income as they occur. So it says that even though there's no conceptual justification for not including gains and losses in earnings, FASB requires that income statement recognition of gains and losses from either source be delayed for practical reasons, which the practical reason is income smoothing. So here you have to deal with something called the corridor. What is the corridor? Well, the corridor is when the PBO versus the plan assets are spread out too far. They differ from each other too much. And so it says, as years pass, there may be more gains than losses, or vice versa, preventing their offsetting one another completely. So if a net gain or net loss gets too large, pension expense must be adjusted. The FASB defines too large rather arbitrarily as being when a net gain or net loss at the beginning of a year exceeds an amount equal to 10% of the PBO or 10% of plan assets, whichever is higher. This threshold amount is referred to as the corridor. When the corridor is exceeded, the excess is not charged to pension expense all at once. Instead, as a further concession to income smoothing, only a portion of the excess is included in pension expense. The minimum amount that should be included is the excess divided by the average remaining service period of active employees expected to receive benefits under the plan, which we know is 15 years from our prior discussion. So here in our illustration, we're assuming a net loss AOCI of 55 million. That was assumed in the example at the beginning of 2018. Recall that the PBO and plan assets were, well, the PBO was 400 million and the plan assets at the beginning of 2018 were 300 million. And so where they get this 1 million amortized pension expense is that they take the 55 million and you look at whether PBO or the plan assets are larger. Here, PBO is larger, so you're going to take and multiply the PBO times 10%. And so that's 40 million. And so you're going to take and subtract the 55 million, the net loss AOCI. You're going to subtract 40 million from 55 million. The excess is 15 million. And as we saw in the previous example, the remaining life is, or the remaining service period of active employees expected to receive benefits under the plan was 15 years. So 15 million divided into 15 years is 1 million per year. So that's where you get this amortized pension expense of $1 million. It's rather mechanical. Even if you don't understand it, that's okay, because it's rather, like they say, it's rather arbitrary. Just remember the corridor. It sounds like something out of the Matrix, if you even know what that is. Some of you are too young, probably. All right. Anyway. So, talks about when do you have gains or losses. Well, when the PBO is higher than expected, you're going to have a loss. But when return on plan assets are higher than expected, you're going to have a gain. And just the opposite occurs when the returns are lower than expected, or the obligation is higher than or lower than expected. If the PBO is lower than expected, you're going to have a gain. If the return on plan assets are lower than expected, you're going to have a loss. So anyway, this idea of the corridor and calculating all that, just be very mechanical and methodical in doing this, and you shouldn't have any problems. Just, look at the example in the book and change it up if you have a problem with this in it, and you shouldn't have too hard a time figuring it out. Now, notice here, your net loss AOCI. You've got a net loss AOCI at the beginning of the period, less amortization for 2018. So you're subtracting by 1 million. You're adding another this loss on PBO that we saw that was given, 23 million. And here, because your gain on plan assets was higher than expected, that actually reduces your net loss AOCI. So that's where that comes in. And so at the end of 2018, you've actually increased the net loss AOCI. All right, we're going to talk about this real quick, but I'm going to stop here for a break and we'll get right back at it.